I want to emphasize again here that we are going to look at the balance of payments as a structure, a model for analyzing how a country's internal domestic macroeconomic situation changes as a result of its interacting with the rest of the world with regard to imports and exports of goods and services, with regard to selling and buying assets, with everything that has to do with interacting with other countries. The balance of payments is nothing else than an accounting activity, but we are not going to look at it from that point of view. If you remember from macroeconomics, one of the things that you did in that course was analyze how governments might implement policy if they feel that growth is too slow or inflation is too high or unemployment is rising, right? Then you had governments applying domestic macroeconomics, demand management policies to try and get things to improve. And that was fiscal policy and that was monetary policy. When you looked at that story, you had something which was a very important variable called the government budget deficit. And basically the only thing you had to know was, is it plus, is it minus, is it getting larger, is it getting smaller, and if it is a deficit, has it been that way a long time? You know, that's all. You don't have to know exactly why the deficit comes into existence. You don't have to know the details. And that's what we're going to do with the balance of payments also. We are going to treat it at a very abstract level. It is going to be very useful for our purposes here to allow us to analyze, again, the consequences for the macroeconomy of international transactions, and as a second step, the consequences for policy by the domestic governments. Okay, because governments are going to be asking themselves a very important question. If we open up our financial markets, allow free capital flows, if we reduce tariffs and allow free trade, is that going to lead to more jobs, higher growth? Is it going to make it easier for us to manage the economy if things go wrong? Or is it all going to become more difficult, in which case there may be a case for shutting your country off from the international economy? Because don't forget, while we're looking at international trade and how it feeds into policy, never forget something which I mentioned in the trade course also, with policies of tariffs and quotas and subsidies and all that stuff, that it's not trade which governments are really interested in. Governments are interested in how they can get their countries to flourish and prosper. And they are interested in how they can possibly use international trade to help them achieve their domestic objectives. Trade is a means to an end. International capital flows are a means to an end. They're not something that should be done just because it's possible, right? So you have to be careful about that. The second thing we're going to look at today is an important sub-balance of the balance of payments called the current account. And let me put it here for all of you to see. It is intimately related to the increase or decrease of international debt. We all know from past history that countries sometimes find themselves in very precarious international but also domestic economic situations because they've managed to get themselves into a position where they have a large foreign debt. How to get out of it? A better question is how to get out of it while still retaining some sort of stability in your country. All these things are very important for governments, and international debt is only determined by the question, is the current account in surplus or is it in deficit? I'll talk about that again later, but that's very important. And it's very confusing. People sometimes don't believe it, or they just, they miss the point, so be careful. Every PowerPoint slideshow which I'll be using and which you can also download will contain in the beginning a list of these objectives of the chapter, also some jargon here, important concepts. this thing, what you should know after reading the chapter and everything. These are taken from the downloadable course guide from the Baldwin, Biblos, and or the Pugel site from McGraw-Hill. So it's nothing new. It's not what I've discovered. It's what the people who wrote the book think you should be able to take home after having studied the chapter. I point it out to you now because these things are, of course, what you should think of as providing the contours for an exam question later. Every lecture will begin with these things you need to know. Well, you should think, to know, right, for the exam. That's what you have to think of, okay? That's what it's about. Now, like I told you, we are going to take a look at the balance of payments at a very abstract level. And this thing, which I'm projecting on the wall here, is going to be our model of the balance of payments. And a large part of today's lecture is going to be devoted to explaining what this represents. Only once you understand how this is built up, will you be able to use it to make some sort of analysis about what's happening to a country. I want to start with everything on the left-hand side of this diagram. As you can see, it represents the private sector, that's up here, and the official sector. And those two categories, again very highly aggregated, represent the entire country. The private sector are all the firms, households, commercial banks, every entity which exists in the country, which is not the government, and which can buy or sell something, whether it be a good, a service, an asset, or whatever. The official sector down here, I'll abbreviate it with CB, is basically only the central bank. Now, in your macroeconomics course, you had two policy centers, let's say. You had the fiscal authorities who used taxes and spending to try and control the economy, and you had the central bank which uses monetary policy. Since the balance of payments, this is a very crucial word, is entirely focused on tracing and understanding money flows, payments made by people in our country when they get something from abroad, and money which flows into the country, representing the demand by foreigners for our goods and services. Right? It's only money flows which are important, and that means we can basically forget about the fiscal authorities. Sometimes they'll be briefly mentioned, but we are actually only interested in the central bank. Because we have to analyze payments and receipts in an international context, we have to start by somehow portraying in our model what people have to spend. And as far as it is concerning financial assets and items, what they already have. And these possessions, financial possessions, I think is a good word, for the private sector are going to consist of three things which together comprise the private sector. I always call it a pile of assets. The pile of assets in the private sector consists of money. It consists of domestic assets, and by domestic assets you should think of government bonds, stocks or bonds issued by domestic business, which the private sector holds for their purposes, saving for a pension or a rainy day or a vacation, or just because they don't know how to spend their money. And you also have in the private sector foreign assets, which are also stocks and bonds and government bonds, but these are issued by foreign entities, foreign firms, foreign governments. The reason why people want to have assets of both a domestic and a foreign nature has to do with spreading your risks. If your country goes into recession, your stocks might yield a low dividend. Well, if you have some foreign stocks and that country is going into an economic expansion, those dividends will rise. It's all a matter of having your wealth allocated in a way which has a certain balance of risk and return. That can change. You can suddenly decide, I want to sell my domestic bond and buy a foreign one. That's what people in the private sector do. They look around, they anticipate what's going to happen in the future, and they make a decision to do something today. In this case, all of three of these assets, like I said, we don't care how they came into existence. They're there. That's our starting point. If you take a look at the official sector down here, we see the same thing. The central bank also has a pile of assets. And in the same way as with the private sector, the central bank has money, domestic assets, and foreign assets. And the foreign assets in the central bank case is denoted a little differently because of the special role that official claims on foreign entities play in our model. Let me just stop for a second. There's some jargon you have to get used to. An asset, right, is also a claim. An asset you have is a claim to future income or dividend. It is a way, it represents your wealth, which you hope grows in value, right? The opposite side of a claim is a liability. Okay, so every asset has an equal and opposing liability on it, right? So in this case, these assets are claims by the private sector on foreign entities, so somewhere out in the rest of the world, there is somebody who owes that person something. In this case, it's a domestic firm which has some sort of promise in the form of a bond, right? I'm going to pay you 10% interest per year, and I'll give you your money back when I feel like it. That's basically what a bond is. Just to review the macroeconomics, how does the private sector get this money? Or even more interesting, how can the central bank alter the amount of money which the private sector has? Why would the central bank want to do this? Well, then you have to go back to your macroeconomics course and realize that a central bank is in a sort of a partnership with the fiscal authorities to try and manage the domestic economy. So the central bank and the fiscal authorities, the other government, let's say, are together trying to analyze and understand what is happening with the macroeconomy and trying to think basically, do we have to speed it up or do we have to slow it down? Now, the way in which the decision-making is split between the central bank and the fiscal authorities, how much independence does the one have, how much strength is the policy by the one as compared to the other, that's all very interesting, and some of it will come, will get some attention in the Baldwin-Wheeler's part. But now just forget all about that and assume that the central bank is basically interested in managing the amount of money. That means the central bank either wants to get it to go up if there's a reason to think the economy isn't growing fast enough or there is too much unemployment, and the central bank will want it to go down if it thinks there's inflation around the corner. We have to get less money in the economy. We have to slow down spending. Well, let's say the central bank wants to increase the money supply. What the central bank then does is it grabs some of the domestic assets which it has, and it goes to this thing here, which is the domestic money market. Except for the time being, just forget all about this part of the graph figure. It has nothing to do with anything. Yeah. So the central bank thinks, I want to get the money supply to go down. I'm afraid of inflation or whatever. So it grabs some assets and it goes to the domestic money market and he offers them for sale. Right? Now on this domestic market, it's filled with thousands of people buying and selling because one guy decides today I'm going to retire, I'm going to sell my stocks, and some other guy thinks I'd sold my house, I have to put my money in some bonds until I figure out what to do. So there's a constant buying and selling for all sorts of reasons. And now all of a sudden the bank is there too. Nobody really knows whether it's the bank or not because it's just somebody offering some sort of domestic asset for sale. So somebody on the domestic, from the private sector, for example, somebody who has just sold his house and wants to put that cash into some sort of asset, a government bond or a domestic firm's stock or something, will buy it. Okay? So what happens now is that the money winds up in the central bank, and this domestic asset winds up in the private sector. Notice that this doesn't change the total assets of the private sector. The private sector doesn't go into debt or pay back debt or anything. It's just rearranging the way it holds its wealth. But there's a very important thing, which you can see here, that is that the money which the private sector has gone down. So the private sector has less to spend, and that was the objective of the central bank, get the spending to go down a little bit so that there will be less pressure on prices to rise, and we can get the inflation to calm down a little bit. Okay? And the other way around, okay? Somebody calls up the central bank and says, we've just got a report from the Labor Department. Unemployment is a lot higher than we thought. Do something to boost the economy. Well, then the central bank will take its money, go to the money market, and it'll buy domestic assets. Remember those people who are all trading on that domestic money market. So that means that a domestic asset will be bought by the central bank, and the money that the central bank uses to pay for that asset will wind up in the possession of the private sector. And in this way, the money supply of the private sector has gone up, right? And that means people will tend to spend more. And with that additional spending, businesses will see their inventories go down, they'll start producing more, they'll start hiring more people, and the unemployment will disappear, hopefully. Okay. Either way, it's basically an exchange of money and assets in the possession of the central bank with money and assets in the possession of the private sector. I told you it's done on the domestic money market, and these letters OMO stand for open market operations, which is the jargon which refers to the central bank's continuous buying or selling depending on what it thinks is best for the economy. Only if the economy is 100% perfect and there is no government official who wants to change anything will the central bank do nothing. There will still be a lot of transactions on the domestic money market, but it will all be among private sector entities, firms, households, etc. Does anybody have a question or a comment about this up to here? Okay. So, this left side represents the domestic country, the home country. What about the rest of the world? Well, that's relatively easy, because that's everything all the way on the right. And we only need one thing to represent the rest of the world, and that's this. Forex stands for foreign exchange market. And on the foreign exchange market, we are only interested in one thing. Is there an excess demand or an excess supply of our home currency? Okay, now just think of it, it's that simple. Is there an excess demand or an excess supply of our home currency on the foreign exchange market? You have all had the simple supply and demand graph. And at the intersection of the demand and the supply curve, right, we have the so-called equilibrium price. By definition, this equilibrium price has supply equal to demand, right? That's the definition of the equilibrium. So there is no excess demand or supply on this market. If this is the market for eggs, then this P star here is the price of eggs. Now, what does it mean when there's excess demand, right? That means that apparently at this price, P star, there are more people who want to buy eggs than there are people who are selling them. That's all. I could extend this P star line to the right, so excess demand would be something like this. What happens on the market for eggs if there's an excess demand? And the answer is the price of eggs goes up. Now, the same thing basically happens on the foreign exchange market. Let's say that the home currency is the euro, and that there is excess demand for euros on the foreign exchange market. Forget about, now for the time being, why that is. I didn't ask you why there was an increase in the demand for eggs either. Right? So there's an excess demand for our currency, and that means that the price of our currency will tend to rise. Now, the big difference with the egg market is that on the egg market, you know, it just happens. And the people who sell the eggs are happy because they get more for their eggs. And the people who demand the eggs, well, you know, they started it. They apparently want more eggs and they've gotten them. It's maybe a little bit of annoyance that the price has gone up, but, you know, that's life. So, you know, that's what happens. And if the next day the demand goes down, the price goes down again, nobody really cares. But that's just what happens. Some countries treat their currency like that. They'll say, I don't care what happens to the exchange rate. If there's an excess demand for the euros, let it go up. If there's well, just think of it, excess supply of euros, what happens? The price goes down. Who cares? Not every country is that casual about what happens to the value of their currency. No country is really so casual that they don't care at all what happens. Why not? Well, obviously, if the value of your currency goes up a little bit, you could always say, well, that's the market, let it happen. But if it goes up again and again and again and again, then pretty soon you're going to find out that your currency is going to cut off your firm's exports, right? Because a high price for your currency means that you are losing your competitive position on the world market. So that means governments, even if they don't really, you know, care about whether the exchange rate goes up or down, they will care if it goes up too much, right? And the same thing, this is less intuitive, is if the value of your currency goes down, you know, the government might again say, I don't care. But if it goes down too much, that's not a good thing either. Now you might wonder why that is. Because the first thing that most people imagine is lower currency, lower value of the euro, good for exports, jobs, blah, 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 because that's what you've been told by the people who benefit from having the value of the euro go down. But governments don't like it that much, because think of what it does to the price of foreign goods. This is something we're going to look at closer later, but you may as well start thinking about it now. What happens to the price of foreign goods if the value of the euro goes down? And the answer is all those prices go up. The reason is that if you have to pay so many pounds for Scotch whiskey, or so many Canadian dollars for maple syrup, or so many US dollars for a Hummer, right? And your euro goes down in value, you're going to have to pay more euros to get the dollars to get the Hummer or the whiskey or the maple syrup. So that means governments don't like it when the value goes down too much, because the increase of foreign goods boosts inflation, and they don't like that. While some companies might like it because they are exporting, think about the countries that have to import oil or wood from Canada or some rare earth from Africa. Right? Those things are denominated in dollars. So if the value of the euro goes down, all those firms are going to have to pay more for the inputs and the raw materials they need from the rest of the world. And they are going to not like that, and they are going to pass those higher costs on to the domestic consumers, and they're not going to like that. And then they're not going to vote for the government, and the government's not going to like that. So there we are back there. A lower value of the euro is not too good either. So what's the story in the end? That means that just like the egg market, some countries will allow the value of the currency to go up and down, but there will be some limits on the top and the bottom. What happens when one of those limits are reached? That's interesting. Let me erase this for a second. And in order to explain what happens if one of those limits are reached, I'm going to make an opposite assumption now with regard to how the government faces the idea of changing currency values. I'm going to use the word price, but this is the price of a currency, so think of it as an exchange rate. Let's say that now, contrary to what I was just describing, the government doesn't want the value of the currency to change. Not at all. Right? The so-called fixed exchange rate regime. I'm certain you've read about in other courses or the newspapers, the so-called benefits of fixed, flexible exchange rates. Or fixed exchange rates is also possible. In this case, that would mean that the government wants the value of the currency to stay at P star. Well, what happens if there is excess demand for the currency now? That means there will be pressure on the foreign exchange market to see the value of the currency rise, but the government doesn't want that, so they have to do something to prevent the value of the currency from going up. Now, they can't really influence the demand for the money because that's coming from foreign firms, foreign consumers, maybe even foreign governments, people who are investing in our country, buying our goods. They want our monies. That's basically it. But what they can do, of course, is get the supply curve to shift to the right. In other words, if there's an excess demand for our currency, you can keep the price fixed by increasing the supply of our currency. Now, we all know that the central bank has unlimited power to print, issue, and spend our money. So it's no trick at all for the central bank to supply more of our currency on the foreign exchange market. And that activity, which again is in response to something, is very important. It's not like the autonomous macroeconomic policy that is done to get growth to go up or get unemployment to go down. This is a policy responding to an unwanted situation, namely a tendency for the value of the currency to go up. If that didn't happen, then the central bank wouldn't have to supply more of the currency. There's a name for this activity by the central bank, and it's called intervention in the foreign exchange market. The central bank is intervening in order to keep the price of the currency constant. In this case, with excess demand, what the country has to do, the central bank, is to supply the whole money. Well, what about the other, just as interesting question? What happens if there's excess supply? How could that happen? Well, this little supply and demand curve graph is something which, get used to drawing it because it's a helpful aid for answering exam questions. So here we have our desired value of the currency. Well, let's say that suddenly the rest of the world doesn't want our tulips or sausage or wine anymore. If they don't want our products, they don't need our money. And if they don't need our money, then the demand for our money will go down. And that means that that original price, we now have excess supply. And we all know that excess supply leads to the value of the currency going down. Again, the government doesn't want that. So what can they do? Well, now they can say, I can counteract the drop in the demand for our currency from the rest of the world by demanding our currency myself. I, as a central bank, will go to the foreign exchange market and demand this gap so that the demand goes back and the price stays constant. Right? There's just one little difference here, and that is that in order to demand the home currency, they're going to have to buy it. And if they want to buy the home currency, they're going to have to use some other currency. You can't buy your euro with euros. That doesn't make sense. You can buy euros with dollars or yen or British pounds or whatever. In other words, you have to demand your currency as a central bank by using your acquired stock of foreign reserves. The foreign reserves, these things, assuming that this is the balance of payments of Euroland, then the foreign reserves are dollars, yen, pounds, whatever, as long as it's not in euros. Now, this is very important. The central bank can therefore use foreign reserves to buy the home currency and keep the price constant. What happens if the foreign reserves disappear? In other words, those assets, those red bars in possession of the central bank, they're used up. Well, the answer is that as soon as that happens, the central bank won't be able to compensate for the shortfall in demand for the currency. And that means the central bank won't be able to prevent the value of the currency from falling. Is that a problem? Well, we'll see in a few lectures down the road that can be a heck of a problem. Because if those foreign reserves are gone, which never happens, the country is going to be forced. Remember, the country started by wanting to keep its exchange rate fixed. But if those reserves are gone and there's still a tendency for the price to fall, it can't keep it fixed anymore. It's going to have to abandon its desired policy. Governments never like to do that. But it's worse in the sense that, like I said, governments don't wait until all those foreign reserves are gone. To the great regret of some governments, at least in some points in time, governments are forced to report in an international framework with the Bank of International Settlements. They are forced to report what's happening to their stock of foreign reserves. That means that every quarter, every central bank of the countries, well, let's say just basically every country in the world that means anything in an international context, will publish a report saying, this is how many reserves we have, this is how much reserves we have now. Well, if the financial markets are noticing that a particular country's foreign reserves are getting less and less and less, and the government doesn't seem to be doing anything to try to prevent that from continuing, then everyone who has assets in that country is going to start thinking, but what happens when they stop preventing the value of the currency going down? Imagine if you had bought a bond from the United States in US dollars, and you believe all that stuff about the hard landing, and you think that next week the value of the dollar is going to be 50% of what it is today. And you think that the government there isn't going to be able to prevent that, maybe because they don't have reserves anymore. Would you keep your money there? Not if you want to retire and still be able to eat, right? Because you want to get your money out of the country before the value of the dollar drops by 50%. But we'll see again later that that is the start of a big headache for governments when people start thinking like that. For the time being, we'll just stop and